operators. So hopefully you find this kind of interesting. This is purely educational. There's no kind of picture in that. Yes?
Chris, could we turn this down a chance or the
Thank you. Yes, easy for that. Easy question. Love it. All right. Okay, so basically, again, purely educational. The goal behind this is really, I say, well, great, I'm here to learn about fund incubation, starting a fund, but what the heck is a fund? Well, believe it or not, a fund, if you could look it up, because I did this, if you look it up in the dictionary, it's literally just an entity to house investment dollars. Period in the end. That's all it is. Everyone makes it sound like this very complicated thing that, all these big financial institutions really use, and the answer to that is that's actually just debt. And so the goal behind this presentation really is to make sure that you guys understand what a fund is, why you even want to do it, and what are the smart ways to actually get it started. So you might be saying, like, okay, well, why would we even be interested in this? Well, believe it or not, with the advent of AI, the ability to actually start a fund has never been faster, better, and cheaper. And so, in my humble opinion, this is a very disruptive opportunity for proven operators or people who are looking to grow their businesses to effectively catch up to what typically has only been sacrosanct in the larger financial institutions of the United States and in the world. And so, there's really two reasons to start a fund. And the first is to grow your company. So if you have a successful company, and you might say, well, I want to tap into outside capital to do so. And so this is a great way to do that. We'll get into the mechanics behind it. The other is maybe you're a proven operator, and you're really sick and tired of syndicating capital. And this is, again, a systemic way to find investments or to basically raise outside capital so that when you do find that deal, you can actually execute. A lot of times, we'll get into this, but a lot of times when you syndicate capital, there's some frustration there. So, my favorite part, the legal disclaimer. Should actually do a AI series on how AI is going to revolutionize legal, but yeah, we're in the business of bold ideas and grounded in rigorous compliance and governance. And especially as we apply AI to financial workflows, it's important to take these things into consideration. The checks and balances are super important. So, from an agenda perspective, the whole idea is we're going to be spending the next 30 minutes on figuring out why you should start a fund, how you should start a fund, best practices, what the tools are to actually do so, and what the right partners are. Because at the end of the day, there's really three legs to the stool when you start a fund. There's certainly the legal side, and there's a lot of focus on the legal aspect of starting the fund. And that makes sense, right? There's all these disclosures, you have outside investors. You want to make sure that everyone knows what they're getting into and what the objectives are. The legal is just one piece of it. I mean, quite frankly, if you start the discussion around starting a fund with your lawyer, and that's it, it's going to wind up to be a very, very expensive legal bill. And trust me, I found that out very quickly, and we'll go into that. But really, it's the legal documents, it is the marketing assets that really have to be institutional grade. You might ask, why do they have to be institutional grade? Well, because you're probably going to get about 10 seconds of someone's time. They're going to look at this, and they're going to say, okay, was this put together, willy-nilly? Or was this being put together by a professional marketing staff? And again, AI can really help it. The third piece is your performance. Anyone who's qualified purchaser or above, and again, if you look at the investor world, you have high net worth. Those folks break into accredited investors, qualified purchasers, then you have family offices, then you have institutions. So when you get into basically certain qualified purchasers and above, because these are basically right-on check sizes, the need to have an underwritten financial pro forma that really ties back to the marketing materials and then ties back to the legal documents to see the report. And trust me, from an experience perspective, it's really important to get through this in an efficient manner, but everything has to be very well done. So again, just a little bit of background on myself. I hate talking about myself, but I come from humble beginnings. I put myself through school by taking on the odd IT job at the University of Chicago. I was a math major. I graduated in '98, so I like to joke around because I could spell IT, and because the world thought the world was falling apart due to Y2K, I was getting 6 job offers a day, and decided that my $250,000 in student loans, needed to get paid somehow, some way. So I was a management IT consultant. Did that for 2 years. It was part of some really cool projects. So it was part of the E-Trade Go Live, the Orbitz Go Live, the Compact merger, and it's because I understood the mainframe as well as the distributed. But I read Rich Dad Poor Dad, and I realized that I knew nothing about real estate, and that wasn't really something I was interested in, but I loved IT. And so I figured, I'll just start a enterprise software company. So I did that in December of 1999. I didn't have any money. I basically had credit cards. And I ran the business on credit cards, called up 13 of my closest friends who I figured, could actually learn IT, because back then in those days, there was no way to learn IT. You had to basically learn from somebody else. And I said, hey, I can't really give you a really high salary, but I can give you room and board for free and equity. And so I had 13 people living in a 4-bedroom, 2.5-bath house, and that was very interesting. Thank God there was no HOA, so it was kind of interesting from a parking perspective. But we grew that organically. It was an enterprise software company that was a part of the automation world. So I've been in the IT automation world for quite some time. And we grew that from 0 to 50 million, all organically, so we didn't use a fund, we didn't use outside investments. It was really the hard way to do it, but ultimately we had a successful exit in Tech Partners back in 2012, at which point the proceeds of that, I started a family office, my family office called Terra Rosa. And then a couple of years later, I figured, I'd really like to get into the fund business to help other struggling enterprise software folks, do the same thing, repeat that same journey. And so I started Incubating Capital, which is our private equity fund. And we started the first fund in 2014. It was a $10 million fund. And we grew that successfully, 2.3 times returned in 3 years, by basically taking the methodology that I learned in my first company and applying it to these software companies that were between 1 and 10 million in revenue. And then Fund 2 we started in 2016, and that was $32 million. We grew that successfully, 2.7 times returned in a little less than 4 years. And then Fund 1 and Fund 2 were supposed to be 5-year funds, but they obviously finished early. They were more successful than we thought. And then Fund 3 started in 2020, which was a very interesting time, right smack in the middle of COVID. And we raised actually $190 million. But it was quite a whirlwind. But we decided that it would be better to make it be more of a big boy fund, 10 years in terms of duration. And obviously, it's off to the races now. So what was interesting was, because of the background that I have, both from a family office, capital markets, and also AI perspective, there's an interesting little intersection. So we would constantly get called at Terra Rosa saying, hey, can you guys help us out with some technology stuff? Especially as the AI started to come out, because I believe that AI is, quite frankly, something that is probably going to be the most disruptive, I think in a good way, force that we've ever seen in modern history. And so we decided that instead of doing all of this kind of bespoke model, we were going to effectively focus on creating a company called Oak Tech Systems. We did that in June of last year. And the whole goal was to create an AI consulting firm that could create solutions and then incubate those solutions into full-blown products and spin them out. So kind of like a Y Combinator, but with a focus on using consulting to identify a minimum viable product, to grow those things into solutions and ultimately then into full-blown products and spin them out. So that's what Oak Tech is. That was just June of last year. Things have been going crazy. So at a high level, everyone thinks that capital markets companies are super complex. They are really not. This is a myth. At the end of the day, you need to find a compelling reason to get capital. You need to raise the capital for that compelling reason. You need to invest that capital wisely, and then you need to look for ways to drive efficiency. This is not some magical system that a lot of folks would think that is, and so it's really simple. And quite frankly, if you look at the core areas here, we're doing educational event series in every single one of these. So today we're just going to be talking about fund incubation. That's the focus. 2 months ago we talked about using AI to accelerate fundraising. We're going to have others as well. The whole goal is to cover this entire system so that from an educational perspective and then from an AI and automation basis, the efficiencies you guys can learn this stuff and then apply them on your own level. So why do this? So why would you even start a fund? So basically, if you're tired of finding deals but the capital isn't there, and then of course the deal goes away, or a lot of people think that the regulatory system is just impossible and it's scary if you do it the wrong way. If you use the right partners, use right best practices, that's done through. If you basically if you choose the right partner, it can really help you accelerate this system in a really big way. Believe it or not, there's $4.5 trillion in the private capital markets globally. 4.5 trillion. So there's a lot of money sitting there, to invest in these alternative systems. And 70% of fund managers are first or second time fund managers. So what does that mean? So first time fund manager is someone who's never created a fund before. It's basically like a startup. And the second time fund managers are kind of the same thing. It's kind of like having a 2-year-old startup. So if you think about it from a global perspective, the fact of the matter is there's so many different funds that have been created that they're all basically startups. So there's huge alpha with these emerging managers, because if you look at emerging managers, or people that are first-time fund managers or second-time fund managers, and you compare them to like the Blackstones, the BlackRocks, the KKRs, the Apollos, all the names that you guys know, the emerging managers actually yield a higher yield relative to those folks, believe it or not, because there's so much capital that it's hard to deploy that in a systemic and efficient way, at least to date. And so emerging managers actually have first mover advantage, assuming they have the right partner, they have the right technology, and they have the right people, to basically take it to market. So it's a very interesting time for sure. So some challenges that you see with the traditional way of doing things, and we'll get into the particulars here in a bit, but typically it takes 12 to 18 months from concept to first close. What is the first close? The first close is when you actually deposit your first check. That's really important. So you're basically starving for a year and a half, and that's not good. And the costs can be quite high. My first fund, just in legal bills alone, it was $150,000 for a $10 million fund. The second fund was $250,000. That was for a $32 million fund, so the ratios got a little bit better. But the third fund was $500,000. And that was for obviously a lot bigger. But what was interesting about this is that the cost of this stuff from a work effort perspective really didn't increase that much. It was associated with the size of the fund. And so there's some interesting areas there to kind of dig into. But typically the fund typically has 15 to 20 people. This is a lot of people, if you think about it. So that's why you don't see smaller funds. Because if you've got 50 people on the payroll, and your management fee, which is how you pay for that payroll, is 2%, do that math, you got to raise a lot of money up front. And that can be very difficult to do traditionally, especially when you're going to be, effectively doing this for free for 18 months. And then the average close rate for an investor is 12%. Very low. So there's better ways to do it. If you want to understand the better ways to get those numbers up, please come to the fundraising events that we have. We have one coming up in Long Beach that we did here two months ago. And there's definitely a better way to do it using AI for sure. So from kind of now into AI. So if you think about 12 to 18 months, now you can shrink it down to 1 to 3 months. And that's huge in terms of time savings. Now you're doing a lot within that 1 to 3 months. The costs are about 65% or more lower than what you can do traditionally. And you can implement very lean teams, assuming you have the right use of automation and technology in general. And this is not theory. This is actually something we're doing today. OTEC, even from a domain capital perspective, we've obviously done this 3 times. But from an OTEC perspective, we are on multiple dozens of projects at this point. So this is not something that is theory. This is something that's actually real, and we'll get into the exact tools that you can use based on the certain stages of the fund development a little bit later. But this is really exciting. Again, getting back to, if you're an entrepreneur or you have a company and you're like, gosh, I really want to get access to this capital, but I want to do it in a really great, efficient way, then this is the time to start doing this stuff. And I believe that early adopters of folks who are looking to start a fund to either grow their business through acquiring other small businesses, or there's a great investment thesis that might actually be practically you guys might be doing today. doing that now is going to be very compelling because a lot of people aren't applying AI to the capital markets world right now. There's no real turnkey product solution for this. You don't just go to www.iwantstartafund.com and all of a sudden magically your fund pops up and oh look at that, I'll go to this other URL, www.ineedinvestors.com and oh look at that, I got investors. It doesn't work like that. There's still a component of this that is super important to do, and it's all based on trust. So the reason why people would invest in your company, the reason why people would invest in investment pieces is quite frankly because there's an understanding around what it is they're investing in and how it is that this is going to grow to achieve an outcome that is positive for them and is positive for you. And so that trust is super important versus buying some random stock that some analyst out there did. So it can be a very good thing. So from a fund incubation framework perspective, there's 5 phases that typically go through. And again, this goes back to trying to collapse this down to 1 to 3 months, traditionally 12 to 18 months, but you got the strategic clarity. So if you use ChatGPT, how many use ChatGPT in this room? Okay, pretty much everyone, yeah. So in ChatGPT, if you have the paid version of it, there is a project folder that you can use, right? And that project folder will learn the context of all the files that you upload into that project folder. So this, again, if you think about the 2 reasons why you would want to start a fund, right? You own a company or you have an investment thesis, you would load up all of those company files or all of those projects that you've invested in historically, and you would ask it, what is my investment thesis trend of all these files here if I was an investor, right? And you can get a lot of good information. Again, getting back to AI, it's all about prompt engineering and doing all these things that are important to really flush that out. But the investment thesis is super important because that is the foundation by which the marketing pillar, the financial pillar, and then ultimately the legal pillar kind of builds out. So strategic clarity is really important. What you don't want to do is say, I think the strategic strategy is this, and then be wrong. Because after you go through all these steps here, and you have to reverse back, it's very costly. People start to lose credibility. So they're like, okay, what are you actually investing in? What am I actually investing in? Not a good idea. Legal structure. Okay, this is where you actually need a law firm. So OPEC is not a law firm, right? So I mean, this is where you really need somebody that can come in, and this is where I'm talking about great partners, right? You can come in, take the inputs that you generate, and regularly get the information out there, into legal format. So that pillar is super strong because you want to make sure to have right disclosures. You want to make sure to have all of the things that are necessary from an institutional perspective that most institutions have built into that legal information. And again, it's super important that as you basically create that strategic clarity, that you keep in mind the marketing and the financials, as a part of that. Then basically that leads into the financial model, which is super important. A lot of people think, well, I'll just build a traditional pro forma. Well, that's not how it works, right? So you got to think about it. You've got the fund, but it invests in things, right? It invests in a company, or invest in companies, or it invests in, in various different assets. So you have many pro formas at the asset level that need to boil up into the fund pro forma so that you can share that information with investors. And they can then look at that and go, okay, John really understood how this interacts. It's actually a lot more complicated because you've got a lot of moving parts at the asset level, and then you've got the fund dynamic, working at that level. You've got to take into account all those variables. So it's a lot more difficult than one would think to build it. And again, AI is not good at financial modeling at this point. It's getting better, but I wish there was a tool that I could recommend to say, hey, look, just look here, and it would actually pump this out, but that's just not true. Marketing tools, however, that's very different. So there's a great tool called Manus, MENUS.ai. It's a tool that you can load up, all the information about your strategy, your pro forma, your marketing assets, and the marketing assets of the underlying assets that you're investing in, and it will actually create fun teasers, fun presentations. You're still gonna have to tweak it, get you to the 20-yard line or what have you. But it's a really good tool that I strongly recommend. And by the way, if for those OPTEC account executives, if you raise your hand, if you do want the code for this, we do have it. Go talk to them, and we'll hook you up. And then ultimately the launch system. So Now that you've got the marketing, now that you've got the financial model, now that you've got the legal docs, you gotta go to market. So how do you just go to market? Do you send 10,000 emails? Well, you can, but that's a good way of damaging your domain, and no one's going to take you authentically. So there's a whole launching aspect of this. Again, if you're interested in diving deep into this, that aspect of it is now we're transitioning into fundraising. We're happy to talk to you, but basically you really need to create a platform that is your CRM system, first and foremost. And we use actually go high level. So Salesforce, HubSpot, those are some CRM systems that you guys may be familiar with. GoHighLevel.com, in my humble opinion, is from a pricing model perspective, something that's very recent, and something that's really scalable. I'm a little biased though, because my background is technology, so it is a little techy, but it's a great tool. So the funnel life cycle is really 6 phases, and it's important at each phase because ultimately speaking, AI accelerates, the validation of deals. It about 40% lower legal costs, 30% more efficient in terms of investor matchmaking, 3 times more deals can be analyzed and deployed, investment can be deployed, and effectively, you get higher returns because if you can do more due diligence on deals in an effective and systemic way, then at the end of the day, you're going to have higher returns. It's just a matter of math. So, kind of a personal story is, when we were kind of going through this, right, you really have to kind of embrace new ways of doing things. A lot of the competition out there, when you look at traditional funds, they're doing it the old school way, which is all manual. It is something that they're cranking through these documents. So whenever you analyze a deal, the typical deal will have between, call it 50 to 300 documents, which is a lot. And so they basically pass it to an analyst. And that analyst has to scour all this information and then basically do a scorecard. That's a lot of work. And at the end of the day, it's something that you still have to be kind of doing this, and you can get inconsistent results. So leveraging AI to accelerate that piece of it, and ultimately speaking, getting to the deployment phase, which again something we'll cover at a later event, is certainly important. But ultimately, the whole goal is to sell all these assets and have an exit event. So what are the components of a fund, right? So the limited partnership agreements are very, very custom. This is not like something where like you go to LegalZoom.com and you get your MBA and you're good to go, right? No, it doesn't work like that. Limited partnership agreements basically dictate the relationship between an investor and the fund. And you have the management company, which manages the fund on an ongoing basis. But then you also have the general partner, which can be the same thing as the management company together. And the general partner basically gets the upside of the carry and so forth. So it's really important that the limited partnership agreement is dialed in correctly based on those inputs. Then you have the private placement memorandum, which is called PPM, and that is effectively focusing on what is the market risks, like what is the investment thesis, who is the team, what is their track record. It's effectively a very in-depth marketing piece that looks more like legalese than regular marketing presentation, but it is super important because it ties back to the LPA. Now, AI, like we talked about Manus, can generate the resulting pitch decks and teasers and all the visualizations that you need. So that's helpful. And again, you still have to do a little bit of work there. But ultimately speaking, if you do all these things correctly with a good proven legal partner, then the compliance aspect of this thing will go through. So how do you make money out of it? You may ask, right? It's kind of important. So there's a couple components to a fund. There's the management fee. Typically, this goes from either 50 basis points to 2% of the assets under management. So if you raise $190 million and it's 2%, it's $3.8 million, for instance. That's something that you get on an ongoing basis until certain things happen, like maybe certain time frames happen where it drops off to employee capital. The second thing is the carried interest. So as you start to sell assets, the whole idea is that there is a profit component of this. And so as the general partner, you basically get access to a certain percentage of those profits. So what is different about typical investments is that, like if I invest in a deal and I put 10% on the deal, like a real estate deal, and that deal does very, very well. I might get 10% of those proceeds. Now, in a fund, however, what happens is the general partner puts in some amount of capital, but ultimately, when they get to that profitability, there's what's called carried interest. And that carried interest gives you 20%, or whatever that percentage is. Typically, it's in from 10 to, it could be as much as 50% of the ultimate profits of the limited partnership of your investors. And so that's why historically people start funds, because you may not have a lot of capital to put into a fund, but because of your investment thesis, because of your network, because of your know-how, you're able to create a lot of value for other folks. You can actually benefit from it. And those are things called waterfalls. So carried interest is kind of a broad term. The whole idea is that investors typically get their money back, and the carried interest kicks in, and then there's some fraction that happens at that point of profits coming back to the general. And then there's other fees, especially in the real estate. There's disposition fees, refinancing fees, acquisition fees. There's all these fees that you can find in these funds. If you're an investor, please read your EPM. That's where you're going to find these disclosures. But that's also another area of potential income for those who are going to start. Typically in the technology space, you won't see that. It's typically very straightforward, management fee, carried interest, and that's pretty much it. But when you get to real estate, it's a little bit more complicated. And then of course you get other asset classes too, and that can actually lead to smart investing as well. So from a compliance perspective, okay, now you've got the legal documents, you've got the right structure, you've got the right strategy, right? So you do need to be concerned about the compliance associated with this fund, right? So there's three areas. There's the SEC, FINRA, and FinCEN, and the whole idea here is that these are the regulatory bodies that effectively look out for investors. And so it's really important at this point to ensure that the regulatory investors, the regulatory bodies themselves, are looking at this fund, and you're doing the right things from a legal partner perspective to ensure that all the boxes are checked, and that at the end of the day there's some issues. AI can actually help automate a lot of the reporting requirements that you see here, which is really nice. But if you do it right from the beginning, then it's certainly helpful. And I would say 95% of all compliance reports can be automated, which is really nice, and it saves you a lot, because the alternative is to hire like a chief compliance officer or something like that, which can be costly. So from an investor quality and outreach perspective, this is kind of multi-dimensional. So the whole idea here is you want to, when you have everything set up, and you want to basically go out and start positioning things, you want to position your fund to market. It's really important that you identify the LPs that are interested. What I would always suggest you do is, before you actually go to market, that you identify some trusted people that you can go to, because practice is perfect, right? You really need to go there and actually vet these ideas by people who are professional investors, hopefully, and they can poke holes in your strategy, and give you ideas on what it is what are those objections that are going to come up my way, and how do I overcome them. So start with a small group before you're actually in market, and test it out. Hey, this is what I'm thinking about, right? This is a draft. Would you mind looking at it? And believe it or not, a lot of people, especially entrepreneurs, they're going to be really thankful and appreciative of the fact that you trust them so much, that you're being so vulnerable in that situation to share this idea and this fun concept, that they're going to hear this and they'll be collaborative with you. Typically, those people typically tend to be, kind of the early investors, the anchor investors. So, it's a good idea to do. But the whole idea is that you ultimately see, once you get through that process of trying to match or trying to vet this idea, this investment thesis by investors, then you want to actually look at all the potential investors that could actually be interested in your fund, and then start educating them, and then ultimately speaking, reach out to them and say, hey, would you invest with us? And a lot of times people say, no, it's not good timing. Hey, it's not something that I would do right now, just because of reasons. And that's fine. You're going to go through a lot of no's before you get yeses. It's a little bit of fundraising. But the whole idea is you want quality versus quantity. You do not want to waste a lot of your time talking to people, because who, from the get-go, if I'm only interested in technology and you're pitching a real estate deal, that's a waste of time. And there's ways to do it. Use AI to analyze what the digital footprint is of that investor so that you can be more accurate and more efficient with your time from a pitching perspective. Because, again, I'll get into my story here a little bit, but you can definitely spend a lot of time in this particular piece. But one of the things that's kind of interesting is if you use AI in this way, typically what we found is there's 65% higher investor engagement and 95% targeting accuracy. So if we took everyone in this room and we said, hey, look, I've got a deal, if we look at it historically, just look at the numbers, it's probably like a 10% match. So the fact that you can get those numbers from 10% to 95%, that's huge, just purely based on someone's digital footprint out there out there in the digital landscape. So that's huge. And typically what we've seen is that jump rate, the close rates, it can go from 8% to 45%. That's also really big, right? So before we cover off, that the typical emerging managers, will close at 12.8%, right? Now you're at 45%. So one out of every 2 meetings that you get should actually result in something, which is good because they've embedded from is this good timing? Can you write a check? Are you even interested in this asset class? All these things, and then you're lined up very different. So again, very powerful to use AI when it comes to that. Now, from a due diligence perspective, you can use AI to do pattern recognition. So again, if you're analyzing real estate deals, you're analyzing companies, and again, this is not so much if you have your company yourself, you'd be using this to effectively analyze the acquisition target, right? So if you have a whole bunch of money, I want to buy this other company, I want to start looking at contracts, I want to start looking at their financials, I want to start looking at all these things that are super important to underwrite this. This all can be automated. And you can effectively create these scorecards automatically, versus before you had to hire some financial analyst to do all this stuff manually, which takes a lot of time. And typically, Harvard Business Review will say that 1 out of every 100 deals that any fund looks at will actually be done, but every deal will cost $38,000 to actually look at it. So if you do the math, that's like basically almost $4 million to do one deal. So if you're a $10 million company and you're trying to do acquisitions, you have one of two choices. Either you can take shortcuts, which is not something I recommend because that's when you make mistakes, or you can do all of this work and you're spending $4 million to do that one deal. That doesn't work. So that's where AI comes in and can actually automate a lot of this stuff because it can say, hey, based on my company, based on my fund pieces, I want to score this information correctly such that I'm spending the right time with the right deals. So I'm going to focus on of the 100 deals that get scored based on a self-service AI interface, and I'm going to focus on the top 10 deals so I can get one of those hopefully across the line. So that's super important. The whole idea is that, again, you're talking about anytime anyone submits something, you're talking about over 200 documents, and it takes that analyst like a long time to go through these things. Most analysts, they're right out of college, they don't have a lot of experience, and so they're making kind of like effectively judgment calls on like, swear this 1 out of 10. I don't know, looks like an 8. And they just kind of move on. So there's a lot of things that can be automated and actually done, that really help to improve the overall outcome. All right, so compliance. So from fund incubation, again, let's think. You use AI, like we talked about ChatGPT, we talked about manage, we talked about templates, we talked about best practice partners. Effectively, all this stuff can lead to 65%, faster efficiency from a fund formation perspective, fund incubation perspective. Typically, you have slow fundraising cycles, right? And we talked about how investor matchmaking and educating can really help to drive the ability to close deals on a much more consistent basis. At the end of the day, you also, might have situations where, the tech infrastructure exists, but you do a lot of things manually. You don't want to do that, right? If there's a workflow system, CRM system, tools that you can use in order to make things more efficient internally inside your organization, I would definitely use them. Because at the end of the day, 2% management fee seems like a lot, but especially when you're dealing with smaller funds, 2% say $10 million, for instance, that's only $300,000. And so there's not a lot of dollars there. We've got to basically make sure that there's good potential as well. Like I've seen my first-time fund managers spend 3 months on compliance reviews that now can actually literally take 3 days, and that's pretty nice. We've also seen the fact that from an investment targeting perspective, we went from saw one client that went from 8% close ratio to 35% as well, which is huge. And one of the first-time fund managers that we talked with said the LPs, the investors, actually complimented them on their system that they thought that they had been doing it for years, even though they were first-time fund managers. So there's a lot of things out there today that we can effectively rely on best practices and tools. So from a best practice perspective, you want to align with your LP appetite. You got to drink your own Kool-Aid, right? So you have this investment thesis, and you really have to vet it out with your trusted folks that you're going to go to. It's super important. When I first started my fund, I sold right in 2012, but I did start my first fund in 2014. And you would think that I knew what I was doing because I just sold my company, and I've been in technology for a very long time. It turns out that I need to iterate so many freaking times, it started to get really annoying. The good news about this is that if you get the right partner, then they can help guide you along those lines, and with AI, you can get the right guidance too. And so it's super important that your investment thesis is really resonating with your investors before you start really any of the heavy lifting, which is super important. Then you want to automate compliance from day one, because I'm telling you right now, if you put compliance on the back burner, and all of a sudden you get going, and you're like, great, I have investors and all this stuff, and all of a sudden you're like, oh crap, I actually have to now do compliance. It will cost you a whole bunch of time, effort, and money that you probably don't have, and now we've got 3 full-time jobs because we still got to do what we got to do to find the deals, underwrite those deals, get those deals done, and manage the portfolio. But also now you've got this compliance headache on the back end that takes a lot of effort to clean up. So boiling and integrating compliance together is super important. You really want to make sure you're transparent with your reporting. Not everything is going to go well. In fact, if anything, everything goes like smooth to plan, that doesn't exist, at least that I've ever seen. So just be transparent with your investors. If that investment is not doing well, just tell them, hey, it's not going well, and here's the plan though to fix it. I know I was really hesitant to this in the early days, but at the end of the day, my mentors said, no, you really have to be transparent, because again, getting back to that trust coefficient, super important to be trustworthy with people, and the way to do that is to be transparent. Good, bad, or indifferent times. And there's going to be bad times that come across, but it's how you handle yourselves in those moments where it's like, gosh, this is really tough. I really made that mistake. That how you actually recover from that, and how you report to folks it will allow you to basically come above the rest for sure. And then from an AI perspective, you really want to use AI to integrate it as a co-pilot, right? Whether you're starting a fund, whether you're doing due diligence, whether you're managing the portfolio, compliance, what have you, it's super important. Running investor relations is super important. And then from a just kind of an interesting client perspective, there was one of our clients that really had a hard time with articulating what it was they were trying to do. Although they had a tremendous track record, but their track record was so diversified that when they went out to some of their trusted folks that they knew were really interested in investing, or had actually invested on a project-by-project basis, the actual investment thesis, the strategy really kind of came out, and they were so at first hesitant to approach these people because they had invested with them before. And they're like, if I go there and I don't necessarily know the fund strategy, what have you, and our guidance on that was like, no, this is great. It's a great sounding board. They already trust you because they would have put money in the first place. So go to them and ask them. And they actually, we can see some investors in that particular asset class, were able to flush that out very quickly, which saved a whole bunch of time there. So from a case study perspective, okay, so again, we talked about how much I spent on legal fees setting up our third fund. One year before we started to implement this from an automation perspective, this is when we launched Institute 2020, so AI was just starting to come out. The manual effort that it took to get to that first close was very taxing. I spent 285 days in 1 year on the road. 285 days. So I wasn't home, for the rest of, basically for 90% of the time, or 80%. So you can do this the hard way. I highly recommend not doing it the hard way, especially these days, because the cost associated with these technologies is so de minimis that it doesn't make sense. But you can do it the hard way, but it's a lot of shaking hands, kissing babies, and if you get it wrong, you gotta start from, the first step, which is that. So again, once we start automation, templates, and go-to partners, these are so much easier. And the results were, typically if you look at a fund, if your fund does really well, you're able to raise 2 to 3 times your prior fund. That's why everyone wants to raise big funds, right? But here's the problem. Institutions, for instance, won't invest in first-time fund managers typically. Why? Because there's no track record. Also, institutions, typically their minimum check size is going to be $25–50 million. That sounds like a lot of money. Well, here's the catch. They can't be more than 20% of your fund. Because from a government regulatory perspective, there's a look-through provision that says that if I'm an institution, I invest in your fund over 20%, then I, from a compliance perspective, have to actually manage your investors for you. It's called a look-through provision. That's not something they're interested in doing, right? They've got enough moving parts in a very large institution with billions of dollars of capital. So if you make that math, it's like, okay, say it's $25 million, but they can only, or $20 million, and they can only be, 20% of the fund, then you have to start out with a $100 million fund. And if you're a first-time fund manager and start at a $100 million fund, I'm not saying it can't be done, it's very, very difficult. So typically what happens is first-time fund managers start, like I did, $10–20 million that align to that asset class. Now that's not necessarily true. Like if you're doing big projects, like if you're creating nuclear reactors, yeah, your first fund is going to be very hard, but you better have that track record to show that you've actually been successful with those types of projects in the past. Carry that experience forward. So it's very difficult to get institutions. So now you go to like high net worth family offices. High net worth typically will raise, they'll make a decision between 0 and 3 months. Sometimes high net worth folks will make an investment decision right out there on the spot. Family offices, however, typically take 3 to 6 months, and institutions literally take a year to 2 years because there's literally budget cycles, investment committees, and things like that go through the account. So it's super important that you start with the right size of fund such that you know that you can show your track record, and get that capital deployed and show that return without over investing in a particular asset. That's also super important. So you do not want to invest more than 20% of your fund in one asset. Why? Something might happen, right? And you just do not want all of your eggs in one basket quite literally. And I've seen fund managers that were just killing it. They were 30–40%, concentrated in one asset, and something happened like COVID. Who would have thought that COVID would hit, right? All of a sudden, their track record is done, and they're no longer, they've got a really black eye, and good luck being funding from that point. So, ultimately speaking, the results speak for themselves. We raised a lot of money relative to our previous fund. Again, usually 2 or 3 times our prior fund. So we really jumped, and we learned a lot in that process. But again, make it due to the fact that we had really good automation, we had access to early on AI, and also we were able to leverage a lot of good strategic partners that were awesome. Next, actually, is this restaurant. So I met these folks here at this restaurant back in 2007. So the general manager, the founders of this restaurant basically came from Morton's, super successful operators, ran the most successful Morton's in the world for a number of years. Before that, worked at a number of hospitality areas. They started this location actually in 2007. So what happened in 2007? The great financial crisis, right? So that's some time. And if anyone knows anything about restaurants, I certainly didn't, but if anyone knows anything about restaurants, starting a restaurant in the great financial crisis was a recipe for disaster. So this was their first location, and somehow, some way, these guys pulled it off. So when I saw that, I said, hey, I want to get to know those guys, because I just moved here, so I didn't know them from Adam. I want to get to know those guys. And so I did. And eventually, JC and William, who are founders of the One Restaurant, basically, I got to know them, talk to them about what is it that they're striving with. Because they had this location, they opened up a second location in Newport in 2010. And their whole idea was, well, JC had this idea of basically distilling this concept of a larger fine dining restaurant into a more chic bistro and lounge entertainment. And, they didn't know how necessarily how to do it, right? Because they had raised money for this location, they had syndicated capital, right? Raised money for this location, raised a whole bunch of different capital for that, the Newport Beach location, which is on PCH and 55. And they were like, but we want to do like these more 3,000 square feet, chic, bistro, lounge type of concepts. So ultimately speaking, we were able to sit down with a number of different strategics. There's already 3 buyers for this fund, and it's when it reaches certain thresholds, which is super exciting. So we already know what our exit strategy is, and we set out to raise $10 million. We hit that off in August of last year, and I know that JC got really nervous around December, because again, you gotta go through that process, right? You gotta matchmake, you gotta educate, and then you gotta ask for the investment. That takes time. Typically it takes around 6 months to effectively get that first close done. So starting in August, came to December, no checks, right? And all of a sudden, January hit, there's checks. Checks started coming, which is good, right? So after you get the first check, and you do your first close, then everything starts to roll. And we targeted $10 million to open up 5 locations, and I'm happy to say that based on the fund incubation aspect, again, we use a lot of AI in this, but also our strategic partners. And then ultimately speaking, we engaged our fundraising system. They're up to, I think they're actually at $16 million with a $27 million soft circle. And what does that mean? Soft circle means that there's verbal commitments that they're going to come in, which that's fantastic. Now that's not to say they're going to take it all, so they clearly already oversubscribed, but it's just an example of, and I didn't realize how hard it was to raise money. First of all, raising money in capital markets is literally the hardest thing, in my humble opinion, to do in this business. If you figure it out, then everything is a lot easier. Second thing, raising money for hospitality is very difficult. So it's like compounding those things. So the fact that this system identified the right matchmaking, was able to help with the educational aspect of it, and ultimately speaking, helped JC, who had never, he knew what a private equity fund was conceptually, but he never understood the concept of starting one. And he's doing a fantastic job. In fact, we just found out this morning someone sent over a subscription document, which is how you, as an investor, commit to the fund for an additional $5 million. So that's not even included in that number. So this thing's going to be great. So. All right, so just kind of key success metrics. Again, you can get to 65% fundraising success powered by AI. You're doing great. You want to reduce your operational costs. If you look at traditional funds versus what can be done from an AI perspective, should be looking at least a 55% reduction. Launch speed should be reduced by 2 to 3 times. And together, these metrics will significantly ensure that your returns or alpha will be a lot higher relative to your competition, which again help demonstrate the power by which this all can come together by taking proven operator success and coupling it with smart capital, which is fantastic. All right, so feel free to reach out. This is last, I promise, and then everyone can grab some food and drinks. But feel free to reach out. Here's my contact information to your left. And then we have a QR code to list upcoming educational events around AI and capital markets. Also, we would love for you guys to join us. We do that here, but we're also doing it in San Diego and LA, and perhaps further. But I want to kind of open the floor. Thank you guys so much. Open the floor for questions, please.
Data being one of those questions.
Good question. So the question is, the question is, how do you identify the gaps with regards to all these different vendors from a data perspective? And so the answer to that is, believe it or not, a lot of these AI vendors out there, right, they're agnostic. They're not specialized, right? So it's really up to every single person to either find like a book that actually specializes in that particular silo, or figure it out on your own. The good news is about AI is that you don't have to know coding. You can, through prompt engineering, you can figure it out. It's really, it seems kind of difficult, but it can be done. And you can get to those answers. But yeah, there's really we're not at the, we're still kind of in the initial stages of AI adoption. I would say the very actually early stages of AI adoption. And we're not even close to where ubiquitously everyone is using AI. It is just starting. And so it's only until we get to that point that people will start to realize one day, like these AI companies will wake up one day and go, how do I compete with this other company? And they'll do that by specializing. But that's the way it's on.
So let's say about how long do you think this is? It's funny with going into these bleeding experts here, nothing. In the capital markets, it's almost like being the last one. How long do you think there's the window in before you see all of this things automated and then actually adopting technology and investing in it?
Yeah. So the question is, how long will it take for the adoption to become specialized?
Well, more so in managing and running the fund, having it entirely automated.
Oh, sure. So financial services, education, government are usually the last to really adopt technology. And
how long are you estimating that?
when I first started out in technology, I could see like 10 years out. I can't even see 2 years out. So that's really hard to say. I think that it's going to come faster than I think we would all expect. But if I said a pure guesstimate, I would say that we're at least 5 years out from a bank or a system, some sort of like fund that's completely lights out, at the very least. I think there's going to be some interesting technologies that come out potentially around that time that make this even more engaging, like quantum computing and stuff like that. So again, I can't see more than 2 years out.
So, what is FINRA or the SEC? What are they saying about AI abuse in this space? Have you bumped into anything?
Believe it or not, I haven't heard much about any kind of regulatory guidance or what have you. I will say right now they're all reeling from the fact that their resources are being pulled from them and they're off the clock today. So, so yeah, AI is probably the last thing right now that they're worried about. That being said, no, I really haven't heard much about it, but again, going back to this question, government's one of the last ones to adopt technology, so you would think they would be embracing this just because of the accuracy level of this, but yeah, it's yeah, I haven't heard anything, but again, I'm not necessarily, I don't know everything, honestly. Good question.
Where is raising funds an alternative or not an alternative for seed capital, angel investing? What's the difference? You have a business idea, when you can expand your business. When it's a fund and when it's like, no, you don't. It's a fund to just grow your business.
So typically, when you're talking, so when you start a business, so the question is, what is the difference between like seed investing, Series A, Series B, versus a fund? Right? So the difference is that if you're an operating business and you are looking for outside capital, you can basically take on investment directly into your company and put them on what's called the cap table, right? And you can do that in such a way where seed is usually the first round of investment, and there's some sort of valuation, and then it's the 10% fund, the 10% of the company, blah blah blah, and then Series A is a higher valuation, and percentages go up. The issue with that approach is that eventually ownership gets watered down, right? And that's why most people that go down the venture capital route. So if you think about venture capital, which is basically taking on money from other people and going through the valuations and so forth and so on. I don't know exactly, I can't remember what the exact statistic is, but most founders actually don't end up making any money with that company because they've been watered down completely to the point where they're certainly not in control and they really don't know about the capital. So now, does that make sense if you're kind of some company that like OpenAI which is growing like crazy? Sure, that makes probably more sense. But yeah, if you're less just like River, then yeah, it's probably going to make a lot of sense and we're gonna know all those things. However, in the fund concept, you can still do the same types of things. So a fund is basically, think of it as a separate entity, right? Money goes into that entity, but those people are limited partners. What does that mean? limited partners are people who do not have governance authority. They're just putting money in and they get economic rights out. That entity then basically comes in as an investor, right, into your operating company. And that particular operating company is effectively the general partner of that particular entity. And so it's a really good way. And by the way, when that company sells, right, the fund as well as that operating company sells, then the general partner, who's the founder, will still get the upside because they get 20% of the upside, whatever the number is from a fair interest perspective, of that deal. And so even though their equity is watered down, their upside still exists. And so that's a different approach, and effectively allows you to delineate between investor relations and all the investment activities that go on to raise the capital into an operating business versus the operation of the business, because they're two different things. Very, very different. So now, again, you don't necessarily want to use a fund concept all the time. Like I said, if you've got a fast growing business and what have you, just gotta be aware that there's a lot of things related to like fallbacks and all that stuff that different capitalists will use, which can lead to some very business. Do a lot of those.
On that bootstrap you're running, like you're running on Jack Ops, what would be some of your perspective on yourself not standing here now going through that?
Finding mentors, that's a big one. I didn't find mentors until I had already contemplated starting a firm. And it took me 13 years to sell my first company, and I guarantee it would have been a lot shorter from there. And I can tell you, the first had my business partners here, right in the front row, having his expertise on the fund level, because he has managed a lot more money than I have, has been just a lifesaver. So, having mentors not having mentors was a big mistake, and now I have a good amount of folks that I get to trust.
It's a good perspective of, having gone bootstrap versus actually, decided, would you have gone maybe raised or stock investors sooner?
Oh yeah, my first company, I would totally.
What would have changed versus this bootstrap?
It would have created I would have had mentors to provide the right path to frequent growth. And B, so the safety nets were there. And B, with that growth capital, I would have been bootstrapping, which took a long time, right? Because it was like, well, I can either make but it was literally 7 years ago. I can either make payroll, right, or not. And we can grow. Like, okay, we're gonna be payroll. That's easy. So, the whole growth of revenue is an interesting delicate balance when you don't have anything else like that. So, super interesting. All right, any other questions? All right, well, thank you guys again for coming out. Please join us for future events.